Listen, if you're not trading the Forex market right now, you're making a huge mistake. I know there are people right now who are sitting on the sidelines who haven't hired a coach, who aren't even practicing themselves, and they have dreams of becoming rich. They have dreams of being able to retire from their job, work from home, or even travel the world. And in this small sliver of time, in this bear market, recession, whatever you want to call it, we have a very small amount of time to be able to trade, grow some income over the next 12, 18, 24 months. When the market recovers, you'll be able to put yourself in a completely different position and your life will be completely different than what it is today. And in this video today, I'm going to show you exactly why Forex is the best financial asset class that you can possibly trade to set yourself up for success over the next 12 to 24 months. So if you're sitting on the fence, maybe tiptoeing around, maybe sitting on the sidelines, maybe not really too sure whether you want to pursue day trading the Forex markets, watch this video and let's get to work. So let's talk about the difference between stocks and Forex. So right now we are looking at the S&P 500, and I'm sure most of you can easily tell when the recession or bear market has started. Now, whenever someone thinks about the stock market, they're essentially relying on the intrinsic value of the asset to fluctuate. So essentially what you're doing whenever you're buying a stock, you're buying a small little tiny little piece, small little fraction of the actual company. So when you have like 4 or 5 stocks, you are a owner of the company, a very small percentage owner. So if the company doesn't do as well, the value of the company declines, and so does your stocks. So whenever you're thinking about a stock, most people buy stocks at a low price and they want the company to do well, which is why you would buy the stock. You want to buy the stock when the price is low to eventually sell it later on once the company's value increases. They want to buy low and then sell high. Or if someone has invested their 401k into an ETF, they want that portfolio to gradually go up over the course of some time. Now, most people are not fancy, crazy day traders, algorithmic traders. Most people just want to put their money into something and just allow it to grow. And they don't really pay too much attention about a technical analysis, fundamental analysis. They just have their money from the 401k sitting in an ETF and they want it to gradually grow. So what happens at a time when a recession is looming or a bear market is on the verge of appearing? What happens is values of these companies start decreasing. Now, during a time of recession, maybe when the interest is high, many companies want to cut costs. They lay off employees. A lot of tech layoffs are happening right now. Maybe these companies don't meet their financial projections, or maybe their quarterly goals are not being met and they do worse than expected. So what does all of this do? All of this lowers the value of the stock. So now let's look at this specifically a little bit deeper. So if you guys remember, this is when the COVID decline started happening, when they started doing the lockdowns, and the economy was about to be in a complete shambles. But what ended up happening is the Federal Reserve, came in. They had their little superhero cape on their back, and they started printing money and essentially preventing the economy from going into shambles and allow the stock market to continue to thrive. This was the time period when people were given the $1,200 or $600 or whatever it was, the stimulus checks. And what did people do with that money? They spent it, which was the actual goal, right? The government gave this money to allow people to spend it into the economy so the economy doesn't crash, so the companies that were doing commerce, that were doing business, to allow them to continue to thrive. So the value of these companies started growing because they started generating income. And what a lot of people started doing as well, a lot of people started putting money into the stock market as well at the same exact time, people that had money in their pockets. So the recession was prevented here and the stock market continued to grow. And as this is happening, inflation is also creeping up as well, and costs are getting higher for everybody. For companies, costs are getting higher for the general population as well. So what has to happen is the Federal Reserve needs to step in and start increasing the interest rate to attempt to slow down the inflation from increasing. So now when interest is creeping up, companies are less willing to invest further into their company's growth or invest further into expanding to different headquarters. And the costs of the high inflation are what's causing the various different companies to start doing these layoffs, the tech layoffs. And a lot of companies are cutting costs. They're not expanding even further right now. The country is essentially becoming into a somewhat of a standstill. So now at this point, there's a lot of uncertainty in the market. The market is not doing what it was doing over the past couple years. So what a lot of investors are doing, they're selling off their stocks because they see what's happening in these companies, and they're putting their money into different asset classes, into alt classes, into alternative asset classes that they can see that they can get higher yield because the economy is not doing too well in terms of the index. So as there's all this looming uncertainty, all this market turmoil, a lot of smart investors, people with deep pockets, whales, institutional investors are taking their money out of the stock market, selling off, and they're putting their money into alternative asset classes. For example, like they're buying a lot of real estate, building a portfolio of real estate, or they're trading into the Forex market, or they're putting their money into precious metals. So when smart money is taking their money out of the stocks and they're putting into alternative asset classes, while the average Joe Schmo investor or someone who just has a stock portfolio, their 401k into the ETFs, their money is just kind of sitting there because they don't know what to do. So while the average Joe's portfolio is decreasing, smart money they're putting into places where they know they'll get a higher yield. So the question we need to ask ourselves is, why are we not doing the same exact thing as what smart money themselves are doing? Maybe you know someone, maybe a family friend, maybe even an uncle or an aunt, or maybe even yourself. Maybe your own portfolio is not doing as well as it was in the past. And listen, right now I'm on the S&P 500 and I'm looking at the weekly chart, but you'll notice this stuff happens over and over and over and over again. So if you're just relying on the economy to allow your portfolio to grow, you're always going to have these downs and then ups and then downs and ups in your portfolio that you can't control. And I'm not saying don't invest into stocks or don't invest into the S&P 500 or any index fund, but always make sure you have a portion of your portfolio into something that you can control, into something that you can do repeatedly over and over and over again to allow the wealth to continue to grow. So these little downtrends, these years of market uncertainty, they don't affect your portfolio overall, and they allow you to make crazy amount of money when others are in market turmoil. So let's look at specific companies in general. Let's look at, let's say, Ford. This company is right now down. We can look at Amazon. This company is down. Let's look at Shopify. This company is down. Let's look at Tesla. This company, over the past few weeks, is up. Matter of fact, it's up by 100%. 100% increase. So you can't just cherry pick stocks and think that, all right, because all the markets are going down, let me just short everything. Because as you can see, some markets go up, some markets go down. Some companies go up, some companies go down. Some stocks go up, and some stocks go down. But if you rewind this video a little bit, maybe the last 10, 20, 30 seconds, you can see clearly that all these stocks started going down roughly around the same exact time. So now let's talk about the Forex market. I'm going to do a quick little experiment. I'm going to cycle through a few different charts, and I want you to tell me if you can determine, if you can try to figure out when there was a recession or when the recession started. Just by looking at the chart, I'm going to hide the years at the bottom. But let's see if you can kind of find out. Let's look at USD JPY first. By looking at the chart, can you tell where the recession or the bear market started? Let's look at Euro USD. Can you tell exactly when or where it started? Let's look at GBP AUD. Can you tell where it started? Let's look at Euro JPY. Let's look at CAD CHF. Notice all of these charts that I've shown you, they're all completely different, and they don't show a same pattern of a bull market and then a bear market starting at a specific time. And that is the benefit of Forex. This is why the Forex market is a recession-proof industry, because whenever we're looking at stocks, we're thinking about the intrinsic value of the stock wanting to go up. Now, I want you to put your Forex hat on and think of, whenever you're thinking about the Forex market, I want you to simply think not of the intrinsic value wanting to go up, but instead, I want you to think of the two currencies, or in other words, the two economies battling it head to head, or essentially just pulling against each other, tugging on each other like a tug of war. So whenever we're looking at a Forex chart, we're not looking at the Forex market to go up and up and up. No, we're looking at it of the two countries or the two economies just battling it out. Sometimes it's up, sometimes it's down, sometimes it's up, sometimes it's down. It's essentially bouncing back and forth. Right now we're looking at CAD CHF. Let's go back to something like Euro USD. It's always up and down, always up and down. And that is a benefit of Forex because you can trade the Forex market in a recession the same way that you were trading the Forex market when the market wasn't in a recession. It doesn't change. We do the same thing over and over and over and over again. So when someone's portfolio in the stock market was essentially going up and then it dips because of a bear market, the Forex market, we're doing the same exact thing over and over and over again because we've learned a skill set that we repeat over and over and over and over again, and it works the same exact way. In the Forex market, there will always be fundamental drivers in the economies that cause the strength of a currency to increase or go down. Whenever we're trading the Forex market, essentially all we're doing, we're just trading the strength of one currency to another. This is why you hear traders mention things like the dollar is strong or like the pound is weak. And the beauty of the Forex market is a lot of traders, especially me, half of my trades are going long and half of my trades are going short. Half of my trades are speculating in the up direction, and the other half of my trades are speculating in the down direction. So it doesn't matter which way the economy is moving. In the Forex market, we don't have any bias that we want to buy low and then sell high. As long as you have a proven, repeatable strategy that you can use over and over and over again with predictable results, you could make crazy amount of money in the Forex market because you've learned an actual skill set that you can use in any type of market environment. And on this channel, I've already posted strategies that are working right now today that can allow you to make money in the Forex market. And I will continue to, over the next few weeks or the next few months, I will continue to post more strategies, more things you can do to optimize your trading and allow you to make money, where when you come out of the next few years, when the bear market and recession is over, you'll be in a much better position than where you are today. And the problem is a lot of people are stuck. Like, they don't take action. They want to have all this success, but they're not willing to put in the work to get the results that they want. So if you're not practicing, if you're not putting in trades, if you're not even trading on even like a demo account without risking any real capital, or if you don't have a mentor, if you're not paying for coaching, you're wasting this small little window of opportunity that we have right now that you can come out in the next 24 months in a completely different position. They say majority of millionaires are made during times of a bear market, times of recession. Listen, over the past few months, I've had my nose on the charts. I've been working, I've been grinding, I've been putting in the work because I know the opportunity that we have right now. I don't know who needed to hear this, but share this with your trading groups, share this with your trading buddy. Let's make 2023, 2024, 2025 the best years yet. Let's get it.